What if I told you that financial crises aren't accidents? What if they're not black swan events that come out of nowhere, but are actually a built-in, inevitable part of our economic system? Decades before the 2008 global financial crisis sent shockwaves around the world, one economist, largely ignored in his time, saw it all coming. His name was Hyman Minsky, and his ideas are more relevant today than ever. Welcome back to Finance House. Today, we're diving deep into the mind of the man who predicted almost every crash, exploring his forgotten warnings about the very nature of our financial world. Minsky's core idea, known as the financial instability hypothesis, is both simple and terrifying. Stability breeds instability. That's right. The very periods of economic calm, prosperity, and confidence are what sow the seeds for the next catastrophic collapse. It sounds counterintuitive, right? We're taught to believe that a stable economy is a healthy economy. But Minsky saw something different. He saw human nature at play. Let's break it down. Minsky identified 3 stages of financing that economies cycle through. It all starts with what he called hedge financing. This is the good, old-fashioned, sensible stuff. After a crisis, everyone is cautious. Banks only lend to borrowers who can clearly afford to pay back both the principal and the interest on their loans from their expected cash flows. Businesses take on debt they can comfortably service. It's a period of steady, sustainable growth. The economy feels safe, solid, and predictable. But this is where the trouble begins. As memories of the last crash fade, a sense of optimism takes over. Profits are rising, asset values are climbing, and everyone feels a little richer. This ushers in the second stage, speculative financing. Now, borrowers and lenders get a bit more adventurous. They start making deals where the borrower's cash flow can only cover the interest payments but not the principal. The assumption is that the asset they're buying, whether it's property, stocks, or something else, will continue to rise in value. They plan to roll over the debt or sell the asset at a profit down the line to pay off the principal. The system is still working, but it's becoming dependent on ever-rising asset prices. The risk level has been quietly dialed up. Then comes the final, most dangerous stage, Ponzi financing. By now, euphoria has completely replaced caution. Lenders and borrowers throw risk assessment out the window. They engage in deals where the borrower's cash flow can't even cover the interest payments, let alone the principal. The entire bet is that asset prices will skyrocket so dramatically that they can sell for a massive profit, paying off the original loan and all the accumulated interest, and still walk away with a fortune. The debt is essentially being paid off with new debt in a structure that eerily resembles a Ponzi scheme. The entire system is now a house of cards built on nothing but pure speculation and belief. This is the Minsky moment. It's the tipping point, the moment when the house of cards finally collapses. It can be triggered by anything, a small rise in interest rates, a slight dip in asset prices, or a major bank revealing it's in trouble. Suddenly, the Ponzi borrowers can't make their payments or roll over their debt. They are forced to sell their assets. But since everyone is trying to sell at the same time, prices plummet. This panic then infects the speculative borrowers, who also find themselves underwater. A wave of defaults sweeps through the system. Asset prices crash, credit freezes, and the economy grinds to a halt. The boom has turned into a devastating bust. Does this cycle sound familiar? It should. It's the story of the 2008 financial crisis almost to the letter. After the tech bubble burst in the early 2000s, we were in a cautious hedge phase. But then, low interest rates and a belief in a permanently rising housing market led us straight into speculative and Ponzi territory. Banks created complex financial products like subprime mortgages and collateralized debt obligations, lending money to people who clearly couldn't afford it, all based on the belief that house prices would never go down. When they finally did, the Minsky moment arrived, and the global economy was brought to its knees. But this isn't just about 2008. You can see Minsky's cycle play out repeatedly throughout history. The Roaring Twenties leading to the Great Depression in 1929, the Japanese asset price bubble in the late 1980s, the dot-com bubble of the late 90s. Each time, a period of stability and optimism led to excessive risk-taking, speculative bubbles, and an eventual painful crash. Minsky argued that this wasn't a flaw in the system. It is the system. Our financial world isn't a perfectly balanced machine. It's a living, breathing organism driven by the all-too-human emotions of greed and fear. So, what's the takeaway here? Are we doomed to repeat this cycle forever? Minsky himself wasn't a doomsayer. He was a realist. He believed that by understanding this inherent instability, we could take steps to manage it. He advocated for strong financial regulation, for central banks to be vigilant about credit bubbles, and for government intervention to act as a circuit breaker during a crash to prevent a full-blown depression. Essentially, he argued that we need a big bank and a big government to step in and stabilize the system when our collective psychology leads us astray. The problem is, These regulations are often put in place after a crisis, only to be dismantled during the next period of stability when everyone forgets the pain of the last crash. The call for deregulation, for free markets, grows louder, and the cycle begins anew. Minsky's work is a powerful reminder that financial memory is short, and that human behavior is the most powerful variable in any economic equation. As we look at the world today, with new asset classes, rapid technological change, and new forms of credit, Minsky's question looms larger than ever: where are we in the cycle right now? Are we building on a solid foundation, or are we caught in a speculative fever just waiting for the next Minsky moment? His forgotten warnings teach us to look past the calm surface and see the underlying currents of risk. Because in the world of finance, the most dangerous time is when everyone thinks it's perfectly safe. Thanks for joining us at Finance House today. If you found this exploration into Minsky's theories as fascinating as we did, don't forget to hit that like button and subscribe for more deep dives into the minds that shaped our financial world. We'll see you in the next video.